In today's video, we'll dive into a proposal that could have major implications for your Social Security benefits. President Donald Trump has promised not to cut Social Security or Medicare, but there's a new plan on the table that could reshape how these programs function. What's his proposal, and how might it affect you? Specifically, Trump's plan to eliminate federal taxes on Social Security benefits could provide financial relief to millions of recipients, but it also raises concerns about the long-term viability of the program. So, what does this all mean for your future benefits and the stability of Social Security? Stay tuned as we break down what's at stake, how this plan could impact the trust fund, and what other proposed reforms are on the table. You won't want to miss how these changes could affect your financial future. Welcome to Financial Area, where we bring you the latest insights on personal finance and economic policy. If you haven't already, make sure to like, subscribe, and hit the bell icon so you don't miss any important updates. During his campaign, President Donald Trump made a significant promise to protect Social Security and Medicare, reassuring Americans that he would not cut benefits or raise the retirement age. These bold statements were meant to calm the fears of millions of people relying on these programs for their retirement security. For many, the idea of reducing benefits or requiring people to work longer before receiving Social Security was a terrifying prospect. Trump's promise seemed like a lifeline to those nearing retirement or already dependent on these benefits. However, while the promise sounded reassuring, it didn't address the underlying financial realities that have put Social Security on a precarious path. Social Security is primarily funded through payroll taxes, which are paid by workers and employers into the Social Security Trust Fund. Over the years, this system has come under increasing strain as the number of retirees grows, and the ratio of workers paying into the system to retirees drawing benefits continues to decrease. Projections show that by the mid-2030s, the trust fund could be depleted, leaving Social Security unable to pay full benefits. If this happens, beneficiaries could face cuts, which would be especially devastating to those who depend on Social Security as their main source of income. This financial gap poses a serious challenge to the viability of the Social Security system. Even though Trump vowed not to cut benefits, these promises are coming under scrutiny as financial experts point out that the program's current funding model cannot sustain itself without significant changes. The question remains, how can Trump honor his pledge while addressing the financial issues facing the program? The answer may not be as straightforward as simply maintaining the status quo. Without addressing these fiscal concerns, Social Security could face even deeper cuts in the future, leaving beneficiaries with less than expected. One of the most talked about aspects of Trump's proposal is the plan to eliminate federal taxes on Social Security benefits. Currently, about 40% of Social Security recipients pay federal income taxes on a portion of their benefits, depending on their total income. For individuals with higher incomes, up to 85% of their Social Security benefits are taxable. Trump's proposal seeks to remove these taxes entirely, which would provide immediate financial relief to millions of Americans, particularly those with modest or low retirement incomes. For those relying on Social Security as their primary source of income, this change could significantly reduce their tax burden and increase their take-home benefits, offering them a sense of financial relief in their later years. While this proposal might sound like a positive step for beneficiaries, it raises serious concerns about the long-term stability of the Social Security Trust Fund. Currently, the taxes paid on Social Security benefits contribute to the funding of the program. If this revenue were to be eliminated, the trust fund would lose a significant amount of income, further deepening the already existing financial gap. Some estimates suggest that the removal of these taxes could cost the trust fund hundreds of billions of dollars over the next decade, exacerbating the strain on a system that is already projected to face insolvency in the coming decades. This potential loss in revenue could push Social Security closer to its projected shortfall, which would ultimately lead to reduced benefits for all recipients. Additionally, while Trump and others argue that economic growth could offset some of the losses from tax cuts and other measures, This relies heavily on the idea that the economy will continue to grow at a strong pace, creating enough jobs and increasing income tax revenue to balance out the loss of payroll taxes. This optimistic view, however, doesn't account for the fact that even with economic growth, the aging population and the growing number of retirees will put increasing pressure on Social Security, making it more challenging to sustain benefits without significant reform or increased funding. While eliminating taxes on benefits could provide a short-term boost for some, the long-term impact on the system is a complex issue that needs careful consideration. As the debate around the future of Social Security continues, various proposals have emerged to address the funding shortfall. Some policymakers argue that raising the retirement age could be an essential part of the solution. With life expectancy steadily increasing, the logic behind this proposal is that people are living longer and healthier lives, meaning they can work for a longer period and contribute to the system before drawing benefits. By pushing the retirement age higher, the government could reduce the number of years people collect Social Security, which in turn would decrease the overall cost of the program. However, this proposal faces significant pushback, particularly from people in physically demanding jobs or those with lower life expectancies who may not have the ability to work longer. Raising the retirement age could disproportionately affect certain groups, making it a politically contentious solution. Another proposed change is adjusting the cost of living adjustments, COLA, that Social Security beneficiaries receive. Currently, COLA increases are tied to inflation, ensuring that benefits keep pace with rising costs. However, some believe the current formula doesn't adequately reflect the true cost of living for retirees, especially for expenses like healthcare. Proposals to adjust COLA could include modifying the formula to better account for the specific inflation experienced by older Americans. While this could help target the needs of seniors, it also has the potential to reduce the rate at which benefits grow, which could leave beneficiaries with less purchasing power over time. As with other proposals, the impact of such a change would vary depending on the individual's circumstances and overall economic conditions. Means testing for Social Security benefits is another idea that has gained traction in certain circles. The premise is that higher-income individuals who don't rely on Social Security as their primary source of income should receive reduced benefits, or possibly no benefits at all. This could help reduce the financial burden on the system by redirecting funds to those who need it most. However, this idea also raises concerns about fairness and the potential for stigmatizing retirees who have worked hard throughout their careers. Some worry that means testing could undermine the principle of Social Security as an earned benefit, where everyone contributes to the system and is entitled to receive benefits when they retire. It also has the potential to create complex eligibility requirements, making the system more difficult to navigate. Lastly, one of the most frequently discussed reforms is increasing payroll taxes, or eliminating the wage cap on taxable income. Currently, only income up to a certain threshold is subject to Social Security payroll taxes, which means higher earners contribute less relative to their income compared to lower earners. If the cap were lifted, higher income individuals would pay more into the system, potentially extending the solvency of the trust fund and providing more revenue for benefits. While this change could help alleviate some of the funding challenges, it could also be seen as a tax increase for the wealthiest Americans. Adjusting payroll taxes in this way might create political opposition, especially from those who argue that it could discourage economic growth or negatively affect high earners' incentive to work. In the face of all these potential changes, one thing is clear. Planning for retirement in an era of potential Social Security reform requires a high degree of awareness. With numerous proposals on the table and the future of the program uncertain, it's essential for individuals to stay informed and plan accordingly. Consulting a financial advisor has never been more important for understanding how any changes might affect personal retirement strategies. Given the complexity of Social Security's financial challenges and the varying impacts of proposed reforms, individuals need to ensure they are making decisions that align with their long-term financial goals and the evolving landscape of Social Security benefits.